Good afternoon and welcome to the Downing Renewables and Infrastructure Trust PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab that's situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Tom Williams. Good morning to you, sir.
Good morning, and thanks everybody for joining us again. I'm really glad to be back on Investor Meets Company. Shall we get straight into it? We're here to talk to you about Downing Renewables and Infrastructure Trust. There are some important notices. Please do cast your eyes over these. They get longer each time. You've got the usual three speakers. Myself, I'm Tom Williams, the head of the energy and infrastructure business here at Downing. I've got Tom Moore with me, who heads up private market operations, and Henrik Dahlstrom, who is an investment director in our energy and infrastructure team. Downing continues to grow, we're very pleased to say. We're delighted to say now that we are very nearly 1 billion sterling of assets under management in the energy and infrastructure business and have more than 80 people looking after them. We've now done around 200 or so of transactions over the last 15 years in the core renewable space. So there is a body of expertise and an understanding there. And we really feel that this is starting to actually bear some fruit for DOR. We can talk to you about that. In terms of why invest in DOR, the first point is that point around that in-house management and expertise. We have a very significant number of people. A large part of those, just under 40 of them, are in our asset management team. All they do all day long is look after these assets and try and preserve and enhance value. And in this presentation, we want to talk to you a little bit about what we've been doing in that regard and try and put some numbers around the value that they have in fact created. And we do have a diversified portfolio. Diversification is at the heart of what we're trying to do. We want to talk to you a little bit about that. I'll refresh on the strategy. Attractive returns. We do think that the vehicle is delivering attractive returns from the underlying assets. I think the share price is a different matter at the moment, and we think that represents excellent value at the moment. We can't buy the assets that we have for the price that the share price implies. There is a disconnect there at the moment, and we do think that represents value for shareholders, but we'll talk to you a little bit more about that later on. And we do make a difference. We hope. We are an Article 9 fund. We do have a sustainable investment objective, and that objective is to assist the transition to net zero. On that diversification, we have here set out on the slide our thoughts on it. So just a very quick refresh. We do try and ensure diversification by technology, by geography. Why do we do this? Because any investment that we make in the renewable generation space is dependent on a given natural resource. If you have a spread of technologies, you are less reliant on any given natural resource. And when you move geographies, you can access different natural resources. You can also access different geographies, different energy markets, and which have different fundamental drivers. And you can also spread your risk to policy changes by investing in different countries as well. The end result of this, we hope, is more stable cash flows, better quality of earnings. How are we doing in that regard? So what you have here is a focus, which we've been talking to you about now for probably about a year, on shareholder value. How do we get the biggest bang for our buck with what we're doing? So obviously, with the share price where it is at the moment, there is a great deal of value in buying back shares. And we have one of the largest proportional buyback programs in the sector, and we are continuing to buy back shares and create value for you. So I think we've bought back just under 6% of shares, and that has created a considerable value on a NAV per share basis. We're also focusing on capital targeted at operational improvements. As I said, we've got a lot of people here who work very hard on trying to improve the underlying performance of the assets, Door is really unique in the sector in that it has assets which do have a more of an operational component. And when you've got that operational component, particularly in our hydropower assets and to a certain extent in our grid assets, you can make a difference. You can make long-term operational improvements that drive value. So a couple of examples here where they have driven that value. So the Mersey shunt reactor, for example, renegotiated the contract there. We'll talk a little bit about that, but that's resulted in a 30% uplift to that long-term contracted revenue. That's a big driver of value. It's £300,000 a year. And the guys have, through a series of actions on the Gabriel wind farm, which again we'll talk to you about, driven around about 5.5 million uplift. Now, given that we acquired that asset for just under 20 million pounds, that's a lot of value that's been driven by the actions of our asset management team. In all of this, what is the aim? The aim is to increase quality of earnings. And again, the earnings have gone up. The operational profitability has increased by about 10%. But also we've increased our long-term fixed revenues by about 13%. So if we just take a second to sort of think about what that means is we've increased profitability and we've decreased risk. Very pleased with that. There's also been a really good result for us in our distribution network in Sweden, where we have had now a regulatory ruling. These regulatory rulings come down every 5 years. They determine what your costs and charges will be and what you can charge your customers over the next 5 years. Henrik will talk to you a little bit about that later on. That's been quite positive. And so what does that mean? It means with all of these things, not only has the cash earnings of the company increased, but actually we've increased the capital value of the company as well. And some stats there. I think over the last 12 months, the company has been the second best performing vehicle in the sector on a NAV basis, so that the performance of the underlying assets themselves. We have made a couple of further acquisitions, and we're looking at some more strategic investments as well. And again, we'll talk to you a little bit about that later on. And this is really emphasizing that point about the fact that we are really focused on driving shareholder value. We're really focused on optimization. So we talked about the capital allocation, talking about that targeted investment of capital, that bang for buck concept. And we're also, the outturn of that, of course, is that we have a progressive dividend. We've increased that for 2 years running above 7%. And the board obviously does support that, and we're looking to be progressive on the dividend front going forward. Talked about that asset optimization. There'll be a couple of slides on that we'll talk you through. Part of that optimization program, part of thinking about where we target those capital investments, is also looking around the estate that we own. That it is a considerable estate now. There's a lot of assets, particularly in Sweden, where we own the land that the hydropower plants are situated on. There's 36 of them in Sweden and 1 in Iceland. So there is quite a lot of estate, a lot of forest around there, but also grid connections. And we're just thinking about how we kind of sweat those assets a bit more to drive value. The way in which some of this value comes through when we pursue these optimization programs is in what we call positive capture pricing. What that means is that you're able to capture more than the average price for your electricity by virtue of operating the assets differently. And this is not possible in all renewables assets. A lot of the assets, they just produce when it's sunny for solar or when it's windy for wind. But with hydropower, with the reservoirs that we have, we can control when we generate, we can control when the water is dispatched, we call it, and we can try and weight the dispatch towards times when prices are higher. And then on average, what you end up with is getting more and more of money per unit of energy generated. And that's a concept that we call capture pricing. And in hydropower, you can make that positive. And a lot of other assets which only produce some of the time and can't really control when they produce, it's often negative. You often have a negative capture price, so less than the system average. We're also looking at the new revenue streams as part of the targeted investment program, looking at frequency markets in Sweden and things like that, where for relatively little cost we can make operational hardware and software changes to the assets and access those new revenue streams. So a quick now update on what the portfolio looks like. Not much change since the last quarter, actually, although we have added a few hydropower plants. So we have hydropower plants, the wind farm and the electricity distribution system in Sweden. We have the hydropower plant in Iceland, and we have the UK solar and the grid services business also in the UK near Liverpool. And there they are on a map. The breakdown, we do like to show this to you because this is part of the differentiated strategy. We do believe this drives value. So here is the breakdown by technology, by power markets. So you can see there that we're in 6 power markets at the moment. We've got the generation by technology there. So we've got quite a decent split between wind and solar, with the biggest proportion of the generation with hydro, which we like, and I think we will try and maintain that kind of weighting, and obviously looking at that by geography on the right hand side. And this is at the heart of our strategy. So you've got months of the year on the bottom here, you've got percentage of annual generation on the left hand side, and this is generation patterns. So what you can see here is the seasonality of different technologies within the portfolio, when they produce more, when they produce less. You can also see that these aren't particularly correlated to one another. Now, the power of that is that if you have a year where perhaps it's a bit sunnier than normal, that's the solar in the orange there, then if the other generation technologies are not correlated to it, then the chances are they're having a bit of a worse year, and vice versa. So the idea is they balance each other out within the portfolio. If you get balanced generation, you get more balanced revenues. And so what we're trying to do is we're trying to make that yellow line there as flat as possible. Ideally, it'd be just a straight line straight across. It's a bit harder than that to deliver in practice, but we are kind of getting there. And the straighter that line is, the flatter that line is, the more consistent that generation profile is, the more predictable our revenues are, the better quality revenues we generate, both throughout the year and year to year. So with that, I'll hand over to Tom to talk about performance.
Thank you, Tom. Afternoon, everyone. So we'll just run through some of the financial movements across the first 6 months of the year. Some of you will be familiar with the way we lay these out here, this stack column chart here, showing our NAV movement across the first 6 months, and the columns within that square box there representing the movements and valuations in our underlying portfolio. The NAV saw a modest increase across the period on a pence per share basis, really supported by the outperformance of the underlying portfolio. The portfolio continues to perform incredibly well, and we've outperformed our performance-based case every quarter since IPO on a NAV perspective, sort of really illustrating the power of the storage capacity on the hydro, the perpetual nature on the hydro, but also the diversification across different technologies and locations. We have been impacted by falling power prices. That's just changing future forecasts alongside the rest of the peer group. But that fall has been more than offset by the efforts that our asset management team have put into the wind asset, as Tom touched on earlier, but other operational improvements and contractual improvements across the period. Overall, taking a step back, that portfolio performance has underpinned a NAV since IPO, which is running at about a return of 9.6% on an annualized basis. That is something that we are really pleased to see, and something that puts us very well placed in the peer group. As Tom said earlier, we're the second best performing in the group on a NAV basis. This is showing exactly the same movement, but now set out by our technologies rather than underlying macro factors. What's really nice to see across this period certainly was that the 4 different technologies all contributing positively to the NAV, largely for different reasons. That really again illustrates the power of diversification across a portfolio like this. There's more to come on the grid sector as well there. Henrik will cover that slightly later on in terms of the value we expect to see coming through there. Just a point on the buybacks. They're obviously reducing our NAV on an absolute basis, but are providing value to shareholders and supporting a small increase on a pence per share basis. The dividend there on that right hand side for the period as well. You may remember that we increased the dividend from last year by 8%. That was the second annual increase in similar amounts, and we are still forecasting that to be covered about 1.3 times on average over the course of the next 3 years. So pretty happy with where that dividend sits today. In terms of some of our macro assumptions, we haven't made any changes to the discount rates that we apply to our portfolio. Our weighted average across the portfolio is maintained at 7.7%. We're really comfortable with that and where that sits in relation to the peer group, especially when you look at our underlying technology risks and also level of gearing. We have updated our inflation assumptions as we normally do, just to reflect the latest data that we've got available at the time, and also moved to a market consensus in the very short term now, just to try and ease some of the volatility that we're seeing in the NAV. Our assumptions are still, we're still very comfortable with our assumptions. Inflation obviously starting to drop now, but no reason for us to move our assumptions any further on. Tom mentioned at the top, we are an article 9 firm. It is something we take very seriously. So even alongside that formal mandate to support transition to net zero, we spend a lot of time, a lot of resources, just managing the land and the waterways, which we have responsibility for as best we can. The scale of the portfolio is substantial, over 1,000 acres of land, well over 200 million cubic meters of water in the waterways and lakes that we manage. For those of you who like the Olympic swimming pool analogy, it's about 90,000 Olympic swimming pools of storage and water that we take responsibility. We are spending a lot of time building up quite large data banks on the biodiversity across the portfolio, and over time we'll start leveraging that data to boost biodiversity habitats across the land, but also make sure we can report on a consistent basis on how we're improving that over the long term. That's it for me, so I'm going to pass over to Henrik and let him talk through some of the portfolio. You might be on mute, Henrik.
Thanks, Tom. Yeah, so post the period end, we announced the acquisition of a 7 GWh hydropower plant portfolio in central Sweden. This is an investment of about 6 million euros. And as this transaction completes, we will be not only expanding the geographical footprint, but we will have a very decent sized hydropower plant portfolio, 37 hydropower plants, 222 GWh of annual production. The key attraction with this acquisition is that the vast majority of the production is in winter time, and that's when power prices tend to be high. We also see upside in terms of improved intraday dispatching. So whilst production predominantly historically has also happened in winter time, and the previous owners haven't been very active of how they use their water resource in terms of what time of day that they dispatch the water. So we see some genuine upside there, how we can operate these assets. We're also pleased to confirm that the FCR rollout is gathering pace with the hydro boxes. We had the first pilot site qualified just at the end of the first half of this year. It is earning revenues. We submitted a second site for qualification in the summer, and we got further qualification submissions effectively ongoing right now. In terms of the batteries, the BESS, we are advancing several sites in terms of grid connections and orders of battery systems for the sites and expect to make the appropriate capex investment decisions during the second half of this year. I think, as Tom alluded to earlier, this is always going to be a smaller part of our portfolio that provides some interesting upsides. We have recently announced some very positive news for our Mersey shunt reactor. This was an asset that we completed the acquisition of in the fourth quarter of last year. And within less than a year of ownership, we have renegotiated the contract with National Grid. National Grid is effectively the customer here. Our original contract with National Grid didn't fully utilize the asset capacity. And National Grid, they were using more than the capacity contracted, and they paid ad hoc for that. So we approached National Grid to make more capacity available for them, and that has resulted in a 30% increase in the long-term contracted annual revenues with National Grid. So it was a really positive news there. In terms of Blåsjön, which is the Swedish DSO grid, this was also an asset we acquired in the second half of last year. We also have some positive news here, as Tom mentioned earlier. And all DSO grids, they have a regional concession monopoly, effectively. And that means that the customer tariffs are regulated. So it's a very similar system in Sweden as there is here in the UK. So your allowable charges to customers, they are in summary based on three different components. You've got a pass-through of operating costs and taxes. You get a charge for depreciation of your fixed assets, and you can charge the weighted average cost of capital, which you multiply by the regulated asset base, the RAB. You can also charge that component to your customers. And the regulator has concluded that the so-called final determination for the current regulatory 4-year period, and the real returns for investors is linked to what the real WACC, the real weighted average cost of capital, is. And in this period, the real WACC is 4.5%, and that's compared to 3.6% in the previous regulatory period. So it's up about 1%. Of course, we are a nominal investor, and the nominal returns are earned through the regulated asset base, through the RAB. And the RAB increases by inflation, and it increases by inflation using the construction index. And the construction index is usually higher than the normal CPI, and that's what you can see on this chart here, where we have both the normal CPI in Sweden and the construction index. And Sweden, just like the UK and most other countries, have had a recent high inflation, and that means that our RAB has gone up to 107 million Swedish krona at the start of this year. And these assets are sort of traditionally valued at around 1 times its RAB, and we paid about 80 million or so, which is reflective of the 2022 RAB. So you can see all that is really high inflation that has come in the last few years. It's really benefited the capital value of this asset. So it's a really good asset in terms of inflation protection, and really pleased that we've seen some strong value growth since we made the acquisition. In terms of our Swedish wind farm, we also have some very positive news. We acquired this asset for about 20 million back in February 2022. So now, 2.5 years later, that value has sort of gone up by 40–45%. And that hasn't just happened by itself. We worked really hard to create value from upsides that we identified at the acquisition. And that value creation, that really comes down to active asset management. And there are 2 key components that we worked hard with. And that's firstly the asset life, and also the secondly contract renegotiation. So in terms of asset life, we've undertaken a detailed technical review. We've identified an appropriate asset maintenance program for this wind farm, and that has concluded that the asset life of the turbines can be extended. Now, crucially, we have then combined that with successfully extending the land leases where the turbines are. And that's, of course, critical to make sure you can realize that asset life extension. So the second part here of the value creation comes down to materially improving the contractual positions for the key contract, and both the O&M contract and the insurance contract have been retendered. The values, lower costs than what was previously in place. So some really good work there, and as we've announced as well, that there is some good news in terms of an indicative offer for this asset as well. Switching to the hydropower, something we very often talk about is how we are driving operational value in our hydro portfolio. Unlike other renewable energy sources, hydro is dispatchable. So that means hydro will produce when you make a decision to produce, as long as you have a reservoir. So that means you can earn a capture price that's higher than the average system price if you dispatch the water when the prices are high. Key to deliver that value is to actively understand our reservoirs, to understand our river systems, and make informed dispatch decisions. If we look at this slide here, what we set out here is to illustrate what a river system can look like, and they can indeed be complicated. This is the Nordsjön river system. We have 9 reservoirs here. We got 43 different gates. We've got 4 hydropower plants. We've got 5 turbines. So there's a lot of different components in this river system. And our dispatch strategy is of course, to seek to optimize the river system as a whole, not just a single hydropower plant. Making dispatch decisions for a river system is complex. It uses a number of variables. So you will look at your reservoir levels, you will look at weather forecast, you will see what the permits are saying. Critically, we will also consider what the power prices currently are, what are they expected to be, hourly in the short term, as well as the trend in the sort of coming weeks and months. The decision making up until now has mainly been done manually. But given the number of parameters feeding into the decision making, the growing size of the portfolio, and the fact that power prices have become more and more volatile over time, we see really great benefits in digitalizing the overall decision making for the dispatching. So in the first half of 2024, we successfully completed our digitalization pilot program with a company called Hydrogrid. We did that for the Nordsjön River system. So starting here in the autumn, in September, we started rolling out Hydrogrid across the estate of all the dispatchable assets. And we're really convinced that this will lead to improved decision making and improvements in our capture prices going forward. Now, we have been, however, working actively with dispatch decisions and making those decisions over the last few years. Even though this has largely been a manual process so far. But we have nevertheless managed to materially improve our capture ratios. And what you can see on this slide here is that for our dispatchable assets, we have gone from a 3% premium on the capture price to 7% in 2023. So that's on the full year basis. If we look at the first half of this year, we can see that the capture price has gone up 1% compared to the previous corresponding period. I think with the implementation of Hydrogrid that I mentioned, we're really convinced that we will see this upward capture price trajectory continuing going forward as well. So I think with all those positive news, I'll hand back to Tom Williams.
Thanks, Henrik. Right. So this section of the presentation, what we normally do is just take you through some of the factors that go into the valuations and the forecast. So obviously a big one is forecast power prices. The guys talked about it during the course of the presentation so far. You can see that those have come in relative to the prior forecasts, so that they are lower. That's fine. That happens. These forecasts do move around a little bit, particularly in the near end. From quarter to quarter. The main message here, though, is that we are able to compensate for any changes in valuations that those might have, either through our hedging arrangements or the way in which we secure fixed revenues. So, for example, 75% or so of our UK revenues for the next 10 years are fixed not subject to power price fluctuations, or through other means. And the guys talked about that ability to drive value in the underlying assets of the portfolio, which is something that is now really starting to come through and has been a real feature of the returns of the company over the last couple of years. And we still do have capital to invest. I talked at the top of the presentation about that real focus on capital allocation, about capital is scarce, so where do we put it to best use? And some of those uses are to acquire new assets, and in particular in the case of the hydropower assets, start that aggregation, modernisation, digitalisation program all over again, which is a multi-year process which releases value, creates value year on year as we go forward. We're only just in the middle of that with the hydropower portfolio at the moment. There's lots of that value still to come through with all the things that particularly Henrik has been talking to you about. But you also get the opportunity to start that all over again and start that process of creating that value all over again when we buy new assets like the 3 assets that we were talking about. So what have we been up to? We have been focusing on where we can best deploy our capital. A lot of that has been in the buyback program. A lot of that has been towards optimizing the long-term operational performance of the assets, which creates real value for our shareholders. We've increased quality of earnings. We've increased the actual profitability while increasing that quality of earnings. And we continue to grow the portfolio. We continue to grow the NAV, and we continue to deliver an attractive dividend. So I hope you've enjoyed the presentation. That concludes the formal part of the presentation. We're obviously very, very happy to take questions. I think if you look at in the Q&A box, in the chat box there, you'll see actually that there is the LinkedIn page for Door is up and running. And so please do just click on that and follow Door. I think actually you should be able to see that in the chat box there. Otherwise, I think we'd be very, very happy to take any questions that you've got.
Perfect. And thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to read the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Tom, if I could just hand back to you to read out those questions, that'd be great. And then I'll pick up from you at the end.
Yeah, no problem at all. I think, right, well, there's one here for Tom Moore, I think, actually. Can you give a breakdown as to how current cash flow is being utilized? You might need to do some checking. For instance, what percentage is used to service debt, pay expenses, optimize assets, pay dividends? Now, we obviously do publish this in the annual report, and we have published this in the interims. So I think that's the first answer is please, if you do have a bit of time and there are some quite large documents, but if you do find your way through them, you will find some of the answers there. But Tom, maybe you could give us a bit of an overview.
Yeah, that's right. So we do publish dividend cover on a look-back basis on every 12 months. Doing it on a seasonal structure such as this doesn't make sense. To try and answer your question more specifically, we dividend cover for our last financial year was 1.2 times. When you strip the debt repayments and amortization and interest out of that, the dividends were covered 1.8 times. So that will give you an indication of how much of the debt there. On the optimization side, certainly on the hydro and a lot of the optimization strategies we've been talking about today, it's not costing a huge amount of money, and it's mainly from the portfolio itself, entirely from the portfolio itself. And those are all accreted on a NAV basis anyway. But rather than me running through the cash flow forecast, your best bet is looking at the annuals. But also that 1.2 times cover for last year, as I said earlier, we're looking forecasting that to be 1.3 times over the course of the next 3 years.
Thanks, Tom. Got another one here with 52% of your portfolio exposure in Sweden and 42% in solar and hydro. How do you plan to further diversify your assets, both geographically and technologically, to mitigate risks? Well, look, the medium-term plan is to go into different geographies. There are still Nordic geographies that we are not in. There are still plenty of Northern European geographies that we are not in. So that could be Germany, Benelux, Poland. It could be the Baltics. We don't have anything in Denmark at the moment, so there's a lot of space out there. We don't have anything in Norway. Actually, in this vehicle, although Danny does manage other assets in Norway in different vehicles, so we have some experience of that jurisdiction. I think the short-term issue is that we had a kind of difficult decision to make with the potential sale of the wind project. So you'll have seen that we announced that we're disposing of Gabriel wind farm. That will reduce diversification in the near term. So why have we done that? We've done that because we've created a lot of value in that asset. That asset has gone from 20 million valuation to a sort of 28, 29 million valuation. It's provided distributions in the interim as well. It's gone up by 50%. We think that's a great result for our investors. We think that from here, we can still drive some value, but it will be obviously less dramatic than the value creation over the last couple of years. So we figured we'd bank that and we'd go again and we'd reinvest. At the moment, the best place that we think we can drive value for our shareholders is to reinvest that capital in paying down the RCF fully. So there'll be zero borrowing under the RCF, and then look at making further acquisitions in the hydropower portfolio, increasing the diversification in that way. So if you're selling it for 28, 29 million, then that's a lot of money to spend on hydropower plants for us going forward. So we'll do that. We'll increase the size of that portfolio and try and drive the value for our shareholders that I've been talking about. You start that process all over again of the aggregation, the modernisation, the digitalisation, which does drive a lot of value in the portfolio. In terms of technologies in the longer term, we'd love to have geothermal in there. It's a great technology. It's not easy to get hold of, and there's only so many jurisdictions. But actually, one of the reasons why we've made the investment in the hydropower plant in Iceland is not just because that's a great asset, but we'd also like a presence there because there are lots of other things that you can do in Iceland, not least of all geothermal energy. The other technologies are, we do like batteries as well. So I think you've got to be careful. You don't want all of your, as Henrik said, we're not a battery fund, right? So, but targeted investments in clever ways alongside other assets that we own, or in different jurisdictions where maybe that the ancillary services markets are just emerging, can be very powerful investments and very accretive. So I think we're just being cautiously picking where we go on that. But there are definitely attractive opportunities. So next question, with the acquisition of 3 additional hydropower plants and growing participation in the FCR market, how do you expect these new assets to contribute to revenue and cash flow stability? Well, I think I've even talked about that actually. So the more of those assets that we acquire, the more efficient we are at operating them as a portfolio. So you drive cost benefits primarily from the aggregation strategy. And then through the modernisation and digitalisation, what you do is you drive revenue growth and cost reduction, but predominantly on that modernisation, digitalisation, we're really aiming at trying to operate them differently and create that long-term revenue growth, of kind of positive capture price that Henrik was talking about. There are a few more here. So we've got, what's your view on expanding battery storage and ancillary services? I think I've talked about that. I think unlikely to do something in the UK. I think at the moment we just need to see how the UK battery market plays out. You've got problem with skip rates. There's quite a few batteries on the market. So I think there's definitely a market there, but I think it just needs to work its way through and find an equilibrium. There are more nascent markets that look a little bit perhaps like the UK was 2, 3, 4, 5 years ago on the battery front, which are within the scope of investment for this vehicle. Those are more interesting for us as battery plays. And as I said, and Henrik talked about this combining of batteries and generation assets, particularly the hydropower in Sweden, but also other types of assets as well, can allow the bigger asset, the generation asset, to access different revenue streams as well. So you can kind of combine them to access the faster response markets. That could be very interesting too, and we're doing a lot of work on looking at that, and think that's quite well. That thinking is quite well progressed. Another one for you, Tom. What's the 1.8 other costs impact on NAV?
That includes it's all the other costs that are not our management fees, but mainly the number is cost to the RCF facility, including interest.
Good stuff. Then can you comment on the uplift to NAV from the wind farm life extension? I missed the first part. Dora's just assumed a longer useful life, or you have invested some capex to generate that uplift. Okay, so you're asking sort of, how have we come to the conclusion that this asset has a longer life? And Henrik, do you just want to just summarize that really quickly?
Yeah, absolutely. So it's not that we just made a different assumption. That assumption was shorter before because we didn't have the new capex program that we've identified. So we've gone through with technical advisors to make sure that if we want to extend the life of these assets, how do we need to maintain them between now and the extended asset life? So there's a new updated capex profile that you need to follow in order for them to last longer. But also critically, if you have a land lease arrangement that ends on a certain day, it's hard for any investor coming in and saying this asset's going to operate longer at no additional cost for us, right? So having extended that land lease arrangement with the underlying landowners is also absolutely critical for you to be able to have a view that the assets' lives are going to be longer. So there's some real contracts in place underpinning this, combined with the capital expenditure plan to support the asset life.
Thanks, Henrik. And then there's a really interesting one. So forgive me, it's quite a long question, so I'll try and paraphrase it. What it's saying here is, effectively, what is the reason for why DOR is trading at a discount, a significant discount? Is it its market cap? Is it because it invests in very small scale assets, or is it something else? Now, I have to say, I've not heard because it invests in small scale assets point before, so I don't think it's that, if I'm totally honest. In fact, those small scale assets and that aggregation strategy that we've been talking about delivers a great deal of value, and that's starting to be recognized by analysts and by the market. So as we said, we've sort of when we see the NAV performance of the fund compared to the peer group, and we receive analyst reports every now and again, we're kind of second in the market over the last 12 months. We may be even top of the peer group, and in fact top of all infrastructure funds, actually listed infrastructure funds. We're up for an award at the moment with two other more broader infrastructure funds, one of which is a renewable fund, over 3 years, which is effectively since we IPO'd. So no, I don't think people are telling us that the strategy or the nature of the assets that we invest in are a problem. I think they're actually saying, ironically, that they would like much more of those smaller assets. They'd like much more of the hydropower portfolio. Actually, that a lot of the analysts are saying, well, the opposite. Why wouldn't you be just totally a hydropower fund? And that has its problems as well. But, so I don't think we'd like to. I don't think small scale assets is a problem. Why do I think we're trading at a discount? I think we're trading at a discount because a lot of the people that invest in us, it's not just retail investors that invest in us, but a lot of the wealth managers and multi-managers, and they are themselves, people are taking money out of investments with those people. And so they have to then satisfy the demand for liquidity, that they've got to find the cash from somewhere to give back to their investors. And what they're doing is they're taking it out across the sector as a whole. And I think also, which is why everybody in the sector is trading at a discount. I think they're also being much more careful, because for the first time in a long time, they've got other alternatives in the alternative sector for their capital. So people traditionally have invested in the alternative sector because it's an alternative to bonds, to fixed income products, because it has the characteristics of fixed income and the characteristics of equity. And over the past sort of decade or so, interest rates have been very low, and so therefore this has looked very, very attractive relative to those risk-free rates. Risk-free rates have been high, and so people have more money in risk-free instruments, government treasuries. Now, with interest rates coming back off again, you're starting to see those discounts come back in, you know, and I think those two are correlated, right? It's a personal opinion, but I think that is, I think other people hold that opinion as well. You know, I think from our perspective, and I'm just trying to read the rest of the questions to see if I've covered it all. I think that fundamentally the sector is re-rating slowly. You know, it's come off 30%, 20% into low 20% and teens discounts. We lag that a little bit because we're a bit smaller than the others, so a bit less liquid. But I see the sector moving in that direction, and I very much hope that will continue. And certainly that we speak to think that will continue as the interest rates continue to decline, and it looks like, again, reading this morning, that it looks like, you know, we might be on for one, if not two, interest rate cuts pretty soon. So from that perspective, you know, I've got a lot of my money personally invested in the fund, and I'm very, very happy with it there. Yes, well, it seems unfortunate that the manager's excellent work seems to be overshadowed by something out of their control. I'm not sure that's a question, but I'm going to read it anyway. That's great. So thank you very much. Who are the sellers of Swedish hydropower plants? Henry?
Yeah, so there's a combination of sellers. There can be individuals who own some hydropower plants. So these latest ones that we just announced, there was a group of individuals who owned it. There's been a few of those that we acquired. There are also sort of regional utilities that can own these type of assets. As also the larger utilities in the region have tended to focus on bigger assets and sold off some of the smaller assets. So there's a big combination of different sellers of this asset class, and we tend to work quite closely with the market. As I think you know, we also have a asset management team in Sweden. We have our own contacts here as well, so we tend to be very close to the market and be able to pick various opportunities up. And people will also come to us. We are a decent sized player in the Swedish market that people know about.
Thanks, Henrik. So we've got a lot of good questions still here. So another one, you noted that you support a progressive dividend policy. However, Dora is also one of the lowest yielders of your peers. Yeah, so I think that's a function of the fact that we're still a young fund. So although we have actually increased our dividend very, very significantly each year on year, we've only been going for a few years. So I think then the question is, can you comment on whether there's scope for material upgrade of dividend in the coming year? So, sorry, no, we can't. We can't really give you dividend guidance on these calls, so apologies for that. But that's not something we can give you. I think what we do try and point you to, though, is increasing profitability, and we try and talk to you about the steps that we're taking to increase the cash generation of the portfolio, which obviously the more cash you produce, the more you can cover your dividend. There is also a point, which is a subtle point, about the fact that half of our portfolio is in perpetual assets. So why is that important? It means the yield that's coming from them is a true yield, right? Because in 30 years, these assets are going to be worth more than they're worth today. There are other elements of our portfolio, solar and wind, which maybe comprise larger portions of other people's portfolios, where in 30 years, those assets are worth nothing, zero, right? So the yield that you're getting in between now and that terminal value of zero represents, if you like, a payment back of your capital plus a yield or plus interest, if you think about it like a loan. So the issue with that is the principal element, the value of your asset that's being dividended out to each year, you need to reinvest in order to maintain NAV. So you would expect yields in those kinds of vehicles to be higher because A, you're yielding more, and B, your dividend cover should be higher because you're yielding more. But you've got to take that portion of the cover and reinvest it to maintain your NAV in the medium and long term. So it's a subtlety. For what does it mean? It just means that there is less risk within our portfolio because we don't have to continually reinvest that money in order to support the NAV in the same way that perhaps we would do if the whole portfolio was made out of solar assets, for example. Talking about solar assets, we've got a question here saying, for the solar assets at the end of their usage, who's responsible for the decommissioning of equipment? It's typically the owner, so that will be the company or its subsidiaries. I suppose the obvious follow-on from that is, well, is that a cost? Do you budget for it? The answer is yes, in a variety of different ways. Sometimes we reserve for it. Sometimes we're required to place bonds for it. Other times we look at that asset life and we think that the scrap value covers the decommissioning costs, or that we can run it for a little bit in order to pay for that. So we look at it in a variety of different ways. That's for the solar assets. We've got another question here saying, not familiar at all with Sweden, any risk of the regulator proposing a switch of indexation from construction index to CPI? So I'm guessing that's a question around the distribution network. Henrik, do you have any view on that?
Yeah, I mean, regulators always, in the UK and Sweden, wherever you are, they always refine their regulatory frameworks, so changes can happen. I don't think you would ever see them do it retrospectively. I don't think I've ever seen that. So the question is probably then going forward. But what they try to capture here is a replacement cost of these assets. So it would be unusual if the index that they would use in the future doesn't capture the underlying replacement cost, and the construction index has tended to be a good benchmark for that. So if they switch, they will switch to probably something else that isn't just CPI, but something that perhaps better reflects the replacement costs. But yeah, I think we're sort of confident that will continue to be an attractive index that's being used.
Thanks, Henrik. Another one here. Kudos for having a steady performance in the declining UK economy. Well, I suppose that's the purpose of alternatives, right? The idea is here that we are an infrastructure vehicle which is meant to deliver essential services that is designed to try and weather some of these issues in the economy. My question is twofold. How do you assess the impact of UK government's recent stance on renewable energy policies, especially in the wake of shifting political priorities, e.g. a possible rollback from net zero targets? And the second question, what contingencies are in place for possible changes in subsidy schemes? So second one first, the simple answer is we don't think there's any effective risk on the government retrospectively removing subsidies from assets that already have them. We think there's very little risk of that. Are we dependent on subsidies going forward? No. A lot of our assets don't have any subsidies, particularly the ones, for instance, in Sweden. A lot of the UK ones do. But in order to generate the kind of attractive returns that we're looking at in the portfolio, we don't need subsidies to do that. Right? Sometimes we choose to buy them with existing subsidies because of the characteristics of the revenue, and we like this combination of assets, some merchant power exposure, some fixed revenues, but we don't need it to give you the risk and reward that we're aiming to generate for you. And then on policy, I have to say, I think that for this sector, for the renewable energy generation sector, and for net zero more generally, I think this government has been a huge positive. So we, as a business, a broader business standing, are engaging with government on Great British Energy, on the creation of the National Wealth Fund, and the inclusion of UKIB into that. They are all those people who are setting that up, who are looking at what these entities are going to do with capital that they've been granted, are incredibly enthusiastic about driving the country towards net zero. I think there's a broad belief in government that this is their route to growth. I think they really see it, as I do, as the industrial revolution of our time, right? And I think they think that you need to be in that to win it. And so I personally think that the government's stance on this is overwhelmingly positive for our vehicle, for all of our peer group, and in fact for the broader infrastructure universe as well. Another quick question here. What's the intent on gearing of the fund going forward? Tom, do you want to cover that one?
The wind sale, if that were to complete, that will be used to repay the RCF and bring the gearing down. But I think in the kind of diversified portfolio we have, that there is always a place for gearing, and it will be at and around that 40% level.
We've got a few more questions here. Given the share buybacks haven't materially affected the discount to NAV, would you comment on whether capital would be better spent in acquiring attractive assets which you can add value, potentially from distressed sellers in a contrarian way? I think we're doing both, right? To be honest, so I do think the share buybacks have a place. They do help support the share price. I think people like yourselves help support the share price. Institutions rarely buy and sell. It's actually retail investors that drive a lot of the share price movements. But I do think the buyback helps. If you think about what we're saying about that capital allocation point, we kind of value the relative differences. So I did some maths when the share price is at 30% discount. We're obviously trading, well inside that now. I think we're more like sort of 25% or so at the moment. At a 30% discount, buying back the company's shares equates to a 15-year IRR of about 14-15%. Now, so that's the benchmark. What can we do with the money that gives you a better than 14% return? And actually, some of the things in the portfolio that we're doing, some of the optimization programs, potentially some of the investments in some of those co-located batteries, they can give you that, and that's why we're doing a balance of these things. It's also possible that you get a core renewables asset like the operational wind farm that we bought that is in a situation where you can frankly pick it up for cheaper than you should be able to and do things with it and dispose of it. And we have the people to do that and the skill set and the ability to identify those opportunities. And one of the nice things about selling the wind farm, if we do complete, is it kind of demonstrates that. Right? Selling an asset for 50% more than you bought it for 2 years ago, it is a fantastic result in this kind of strategy. We do have a couple more. Sorry. So we've got, can you give more detail on the rollout of Hydrogrid? When will it be fully rolled out across the portfolio? Henrik, it's definitely one for you.
Yeah. So during the second half of next year is when we should be fully rolled out. So it's work in progress.
Yeah, and it's multi-years, right? And the great thing about it is it just delivers value over many years, because we, as more and more of the portfolio is modernized and digitalized in this way and included in this kind of dispatch strategy, then more and more value is created. So another one here, in respect of the current share price to NAV discount of 26.6%, how many shares would need to be bought back to theoretically eliminate this? I have to say, I don't think I've ever done the maths, probably a lot. And not something that I think we would anticipate doing. I'm not sure we would anticipate using the buyback in that way. I think what we are trying to do is we are trying to show people that there is value in the shares at or even above NAV, which we strongly believe. And we're trying to point people to all the things that we're doing to drive that value that is not yet in the NAV. So the NAV's got some way to go, we think, with different initiatives that we're undertaking. And so that's the way in which we think we attract people to the company. When people are attracted to the company, they buy the shares, the share price goes up. So that's what we're trying to do. The buyback at the moment is just representing great value, as I said, for the company. So there's no harm in buying back our shares at this kind of discount, because we know we can't buy the assets, a lot of the time at the kind of value that the discount implies. So why wouldn't we buy our own shares? It's a vote of confidence in our NAV, and it's creating value for you, the shareholders. On the face of it, importing BESS across the hydro portfolio appears to be quite slow. Can you please talk through the process and why it takes so long? The long and short of it is you need a whole load of permissions, which takes you a while. You need building permits. You need local authorities to be on board with what you're doing. You need grid connection offers or variations of your grid connection offers. You don't need land, fortunately, because we own the land, so you don't need an agreement with the landlord. You also need to be absolutely convinced that it is going to deliver the money that you want it to. And frankly, that's something that we won't rush. We'll make sure that what we're doing is going to deliver the returns that we're promising people. And if it doesn't work, we'll do something else. But at the moment, there's an opportunity there. We're working very hard on those opportunities, and we'll see what comes of it. And then I think there's one that says here, there's a view from some investment trust commentators that for critical mass, a fund needs to be bigger than a 500 million cap. Is this an issue? Given Downing can't currently issue any further equity. It's I think this is probably the number one thing that people talk to us when we talk to the analysts and some of the really big investors. They'd like us to be bigger, and we'd like us to be bigger. So I think we need to narrow that discount. We need to get share price back to a level where we can issue. In order to grow, we need that to happen. We need to show people that we've got a viable strategy that is delivering really good value consistently year after year to shareholders, which I think we are doing. And we need to show people or convince people that we can do that in the future, give us more money. All of those three things, I think we're very confident that we can demonstrate to people. There are fantastic deals to be done out there. It's one of the reasons why we're disposing of the wind farm, because we can bank our gains there and we can go again and invest in new assets and try and drive capital value in that way. And if we had 10 times that money, we'd be doing that too. So, and I think, who knows what the magic number is, 500, 400, 250, I think there's always a number that's bigger than what people would like you to be, right? Including ourselves. So I think we just need to crack on, keep on delivering returns for people, and try and get back to that place where we can grow. And when we can do that, we will deploy the money to the best of our abilities. And so far that's worked out okay.
Perfect. Well, I'll just jump in there. I think you managed to get through all the questions, so thank you very much for your time. Just before redirecting investors to provide you with their feedback, which is particularly important to the company, Tom, I was just wondering if I could ask you for a few closing comments.
Yeah, well, I'm pretty much talked out now. So I think by the time we've got through the questions and the prezzo, I hope we've given you a feel for what we're up to. I hope we've given you a feel for the fact that we really believe in this vehicle. We think it's got fantastic prospects. We think it is differentiated, and because it's differentiated, because it does have things that we can do inside the portfolio that can drive the value, we really think we can continue to do that, and that's what we get up and do every day. So thanks very much for your support, and please do get out there, buy some shares, and help us narrow that discount. Thank you.
Tom, Henrik, Tom, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Downing Renewables and Infrastructure Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.